where we will continue to bring some of the most relevant and pressing financial topics.
Welcome to Titan Talks. Hi, everyone, and welcome to this week's episode of Titan Talks. My name is Nick Milano with Titan Investors, and on this episode, we're going to dive into certain aspects of merger arbitrage and how it can be implemented into high net worth individuals' portfolios. And joining us today to share his expertise in merger arbitrage is Mario Valente. Mario is the Deputy Chief Investment Officer at Stansberry Asset Management, which is a new registered investment advisory firm based out of New York with around $750 million in assets under management. Stansberry definitely has a pretty unique perspective on M&A investing for their clients. And so we're very glad to have Mario joining us today to share some insight on it. But yeah, without further ado, thank you so much for coming on today, Mario.
Thanks, Nick, for that. I appreciate it. And thanks for having me on today's Titan Talks. So just to kind of echo a little bit what you said, Nick, my name is Mario Valente. I'm the Deputy Chief Investment Officer at Stansberry Asset Management, a registered investment advisor that internally constructs portfolios for separately managed accounts. And given our professional backgrounds, we pride ourselves on implementing alternative equity strategies that can only be typically be found under the roof of an institutional asset manager. And the primary strategy that we employ here is merger arbitrage, which is quite simply an uncorrelated method of investing that could potentially reduce the volatility of a traditional equity portfolio. And the strategy is largely dependent on the occurrence of a singular corporate action, namely the successful closing of an acquisition.
Awesome. And maybe we can go a little bit deeper and get into some of the basics of merger arbitrage and how you guys are looking at it right now.
Sure. So let me talk a little bit about the basics of merger arb. So when a corporate acquisition is announced, the stock of the acquired company usually jumps up and closes the day at a price pretty close to the acquisition price, but oftentimes a little lower. And that difference between the takeover price and the current market price is oftentimes referred to as the deal spread. And this deal spread will widen or tighten over time based on the perceived risks surrounding the transaction. And some of these risks may be the following. It could be that the acquisition may not go through due to antitrust issues or breach of conditions mentioned in the deal. Part of the deal may be in stock of the acquirer, and there's a risk that the stock of the acquirer may drop in value before the deal is completed. And also, if it's a very large deal, there's also a risk that the acquirer may not be able to raise the required capital to complete the deal. And so investors who understand the specific dynamics of each corporate merger can profit handsomely from capitalizing on this spread over a relatively short period of time, usually 3 to 12 months. And also remember that because these investments are contractually obligated to close at the agreed upon price, barring any regulatory setback, these investments therefore trade with very little market beta risk. And so a textbook example would be the case of IBM's acquisition of Red Hat in October 2018 for $190 per share. On the day of the deal announcement, the stock closed at about $170 per share, which reflected a 12% deal spread to the actual takeover price. And the deal closed in line and within the 8-month initial timeline and without incident, which is a perfect illustration of how a manager can exploit a positively asymmetric merger arb investment for their clients.
That's awesome. And so why does Stansberry Asset Management, why do you guys find merger arb so compelling and useful?
Sure. So we find the risk reward characteristics extremely favorable. They're perhaps best exemplified during periods of extreme market volatility. Now remember that absent any litigation, mergers and acquisitions are contractually obligated to close at the agreed upon price. So let's take a look at this year, for example. So through May 11th, through yesterday, the S&P 500 was down about 18%, and the NASDAQ was down a whopping 27% year to date. Conversely, the S&P Merger Arb Index is only down 3.5%. So despite a significant drop in equities, merger arb investments hold their ground due to their unique idiosyncratic risk. And perhaps as equally as important, the opportunity set for merger arbitrage remains the most attractive it's been from a relative standpoint since the onset of the pandemic. So let's go back to the beginning of 2021, right? So both the Bloomberg Barclays US Corporate High Yield Bond Index and the S&P Merger Arb Index yielded approximately the same 5%. But fast forward 17 months to the present day, and the divergence between the two strategies are very stark. While the high yield index has widened today to about 7.5%, the merger arb index has skyrocketed to about 16%. And so because of the strategy's unique characteristic of lower beta, we believe that merger arbitrage offers much better risk-adjusted returns than traditional high yield. And so therefore, the foundation of our investment philosophy at Stansberry is that a well-managed exposure to this specific asset allocation provides an optimal hedge during periods of distress, while also offering potential for meaningful upside as well.
That definitely makes sense. And can you discuss some of the past macro regulatory dynamics that are surrounding merger arb?
Sure. So I think it's a good time now to kind of start the conversation by just kind of briefly outlining the major themes that have collectively influenced deal risk in the merger arb space over the last couple of decades. So I started investing in merger arb around 2006, just prior to the financial crisis. So I had a front row seat to some of the drama that eventually transpired as the capital markets seized up. And specifically, some buyers that inked deals just prior to the crisis started to question the intelligence of these corporate actions. And in other words, they got cold feet. And most tried to invoke a violation of the material adverse change, or MAC clause, in order to scuttle the deal. So as a reminder, MAC clauses are notoriously difficult to enact, with buyers needing to be able to prove there's been a sustained decline in a target's business, rather than anything caused by a short-term event. And the terms of these contracts can vary widely, and the ability to invoke them can come down to the precision of the wording in the merger agreement. And so as a result, there's really only been one example in the US courts where a buyer has successfully asserted a MAC clause to terminate a pending acquisition. And so nevertheless, some large buyers did manage to wiggle themselves out of some deals, but not because of a court ruling, but because the smaller sellers were simply scared of the material time and resources that would be necessary for such a titanic legal battle. And so as we exited the financial crisis and entered a new era of rebuilding and growth, other macro risks emerged. So for example, the Obama administration was characterized by their regulatory focus on preventing monopolies, and they did so successfully across a wide array of sectors. They scuttled some notable large-scale mergers across telecom and pharma and even oil and gas. And the Trump administration, conversely, had been engaging in a trade war with China over the last several years, which has resulted in a tit-for-tat protectionist quarrel that has scuttled some major semiconductor deals, namely the $45 billion Qualcomm NXPI deal that was ultimately denied by Chinese antitrust authorities in the summer of 2018, throwing many merger arb investors over the handlebars and creating an era of regulatory distrust between our two countries. And then during COVID, after nearly a 13-year hiatus during which merger arb risks revolved around other issues, right? The idea of invoking material adverse change clauses to scuttle a deal had returned. So as buyers got spooked by the rapid deterioration of global commerce. So for example, a shopping mall operator, Simon Property Group, threatened to walk away from their deal with Taubman Centers. And despite airtight language in the merger agreement that stated that specifically Simon Property Group could not walk away from the deal due to pandemic-related reasons, the two companies ultimately renegotiated the price 18% lower. And so next question would be why? Why did they do that? Well, because Taubman Centers, unfortunately, was in a position of material weakness and simply couldn't afford a protracted legal battle with a much larger, deep-pocketed entity. And in fact, Nick, you're actually seeing this exact same situation play out today between Elon Musk and Twitter. And I know he recently tweeted, I think this morning, that he wanted to independently verify the accuracy of some of the company's user data before proceeding with the acquisition, but most believe it's simply an underhanded ploy to reduce the acquisition price. So what's the takeaway, right? What's the takeaway? I would say, as a merger arb investor, don't underestimate the power of buyer's remorse, particularly when investing in a deal where the target is not necessarily operating from a position of weak strength like Twitter.
That definitely makes sense, and I appreciate you kind of setting the stage on how regulatory impacts and how those dynamics have evolved over the past. You started in 2006 with merger arbitrage investing, how it's evolved and what you've seen. Can you just, I know you touched on Twitter a little bit, but can you go a little bit further into the current dynamics and what's going on today?
Sure. So there's one particular risk that has recently grown in significance, and so over the past 6 to 9 months, the Federal Trade Commission, or the FTC, has acted much more aggressively towards U.S. mergers and acquisitions. Across different sectors, merger arb investors have become very wary about paths to completion and the increased regulatory scrutiny. So the FTC's new chairperson, Lina Khan, said in August of last year that antitrust enforcers should more frequently move to block mergers that threaten competition, rather than relying on traditional remedies to fix those deals. And additionally, top federal antitrust officials have announced a review of how they're going to approve mergers and acquisitions in a broad effort to strengthen enforcement and really clamp down on a surge of corporate consolidation, They effectively want to rewrite the merger guidelines created over a dozen years ago because the regulators feel the old guidelines didn't directly address the new and unique problems raised by a variety of industries. The regulators also said they were interested in broadening the scope of antitrust enforcement to consider potential ripple effects of corporate concentration on labor markets, on innovation, and even consumer protection. And perhaps I would say the most impactful gesture occurred last year when the FTC began a review of guidelines for so-called vertical mergers, which are essentially the acquisition of companies adjacent markets that are part of a supply chain, So the FTC argues that oftentimes larger companies acquire scores of other smaller companies that don't necessarily directly compete with their main businesses, but have helped these giant conglomerates gain exposure into new markets, thus further cementing their dominance, And in fact, the FTC is even moving forward with this antitrust case against Facebook, alleging that the company is a monopoly, The FTC is essentially looking to break up Facebook and force the company to sell WhatsApp and Instagram. And so as a result of this new recent paradigm, many absolute deal spreads in the merger arb universe have blown out to 15 to 25%, with the expectation that they will not pass U.S. regulatory muster.
So I guess having said that, do you think that these current dynamics make merger arb essentially uninvestable?
That's a great question. I get that question all the time from investors. And what I would say is, with this new paradigm of regulatory uncertainty, right, coupled with overall market weakness, this has created some enormous deal spreads across the merger arb landscape. And in my mind, for those of us who have historical context and have been critically analyzing this space for the last 15 years, I would say, and we would say collectively at Stansberry, this type of environment is rife with opportunity, right? So for example, in December 2021, only 4 or 5 months ago, Pfizer announced a $100 per share all cash takeover for Arena Pharmaceuticals, and they guided for deal closure sometime in the first half of 2022. But by the end of January, the deal spread had blown out to 11%, mostly attributable to regulatory concerns that were largely misunderstood. So Arena's star asset, right, is in late stage development for ulcerative colitis and Crohn's disease. And the mechanism of action is such that it blocks the ability of immune cells to enter the central nervous system, thus reducing inflammation. And while Pfizer had other compounds in development to treat ulcerative colitis and Crohn's disease, they have different mechanisms of action. So Pfizer's primary argument was to show the regulators the need for different mechanisms of action in these specific disease areas, right? And the fundamental key to this argument was that Pfizer had precedent on its side. We already knew that the last major pharma deal, which was the $11 billion takeover of Acceleron by Merck in November of 2021, was also incorrectly plagued with antitrust concerns. And Acceleron had a late-stage compound in development for pulmonary arterial hypertension, or PAH. Merck already had a drug in development for PAH, but it was for a different mechanism of action, right? Sound familiar? Well, it should, because it's nearly the identical situation to that of Pfizer and Arena. And so what happened? Well, Merck ended up closing the deal only 52 days after deal announcement. So coming back to Pfizer, it turns out that the regulatory fears were premature, and the deal closed in mid-March, only 90 days after deal announcement. So therefore, had you purchased Arena stock in late January, you would have realized an 11% return over the subsequent 10 weeks, which is not bad considering the S&P 500 over that same time period was down 4% year to date. So even Warren Buffett mentioned at his shareholder meeting a couple of weeks ago that one of his favorite investments just happens to be a gaming company in the merger arb space, trading with a 23% deal spread and scheduled to close in a year. And look, there's certainly some degree of risk that an overzealous antitrust regulator is looking to make a case against big tech and may file a lawsuit to block the deal, despite the two companies not even having much horizontal overlap. But the video and game business is highly competitive. And when the transaction closes, the combined entity will become the world's third largest gaming company by revenue, behind Tencent and Sony, which would not be an insurmountable issue under a normal antitrust regime.
Yeah, thank you so much for that, Mario. And I really appreciate you kind of just explaining everything that you've learned from merger arbitrage and your experience with it. But I just wanted to give you kind of the floor for the last couple of minutes here before we close out, and see if you have any final thoughts, or and why folks should maybe consider merger arbitrage when constructing portfolios for their clients, rather.
Sure. So look, at the end of the day, merger arbitrage in our minds lays a foundation for meaningful, uncorrelated returns, which is extremely compelling, especially in a market environment where overall volatility is spiking like today, and the ability to invest traditionally, Nick, really is, it's a Herculean endeavor.
Awesome. Well, thank you so much. I really appreciate you coming on today, Mario. This has been incredibly insightful, and I think a lot of people are gonna get a lot out of this. So thank you again.
Thank you, Nick, for having me. Thanks so much.
And thank you to everyone listening in. Be sure to go ahead and follow Titan Investors. That way you can stay in the loop and also catch next week's episode of Titan Talks. But until then, thank you and take care.